Well, good morning, everyone. It's now on 11 a.m, so we might make a start. I'd like to welcome you all today to today's joint webinar, BetaShares and Franklin Templeton, titled Using Active Fixed Income ETFs in a Low Interest Rate Environment. Today's webinar will be recorded and you'll receive a link of that recording and the slides at the end of the webinar. Anyone in your office or any colleagues that did register but could not attend will also get a copy of the recording. You'll also have the opportunity to ask questions as we go through, and we will dedicate some time at the end to addressing them. To ask a question, please click on that question mark icon in the GoToWebinar widget and type in the text field as you see there on screen. And one final bit of admin, if you could please take a moment to read the information or view the information shown on screen. Obviously, all information in this presentation is general in nature and does not constitute personal financial advice. For any personal advice, please see a financial advisor. Great. Well, it's my pleasure today to introduce Jonathan Baird for today's discussion. John is Head of Client Service and Marketing for Australia and New Zealand at Western Asset Management. Western Asset, for those of you who don't know, is one of Franklin Templeton's specialist investment managers, and they focus on the world of fixed income. John has 12 years of industry experience. Prior to joining the firm, he worked in fixed income at UBS Asset Management and at Zenith Investment Partners. Welcome, John.
Hi, Cam. How are you going?
Good, thanks. So my name is Cameron Gleeson. I am Senior Investment Specialist at BetaShares. I've been working in financial markets and asset management for 16 years now. And my role here is to assist our clients with asset allocation and portfolio construction. Again, I'd like to thank you all for joining us. So look, we've got here a brief overview as to what we'll cover today. I'll be giving an update on BetaShares and our partnership with Franklin Templeton. John will cover Western Asset, their approach to fixed income and their insights on the global macro environment, so where we are now and what the future looks like. John will also talk about portfolio positioning for Western Asset's flagship Australian fixed income strategy, which you can buy and sell on the ASX under the ticker code BNDS. I'll then be looking at how to use BNDS in client portfolios. And we'll wrap up by answering some of those questions that have been asked by the audience. So as you will already know, BetaShares has been a real leader in the ETF space in Australia for over 10 years now. During the turbulence of 2020, we've actually seen very consistent, significant inflows into BetaShares funds. We've been number 1 or 2 throughout the year for inflows, and our assets under management are now actually approaching 15 billion. So look, we'd like to thank everyone out there for their support who's been using our funds in client portfolios. We certainly appreciate it. BetaShares has the widest range of exchange-traded products on the ASX, and we believe our role is to provide the tools so that investors can build robust, diversified investment portfolios that perform across the market cycle. We're obviously well known for our passive and rules-based fund strategies, but we also partner with a number of leading active managers in specific spaces. We offer 4 active ETFs in our partnership with Franklin Templeton, which originated through our partnership with Legg. Today, we'll focus on fixed income and the BetaShares Legg Australian Bond Fund, which is actively managed by Western Asset. This fund trades on the ASX under the ticker code BNDS. Franklin Templeton, of course, was acquired Legg in July 2020, so coming up to 5 months now. These 4 funds names that you see here on screen still bear that Legg label, but in the near future we'll be making a change to those names to reflect that change in ownership. However, the ticker codes that you see will remain as is. The acquisition of Legg and its specialist managers like Western Asset and Martin Currie has really established Franklin Templeton as the world's 6th largest independent asset manager, $2 trillion under management. They cover all the major asset classes and provide access to a number of really high quality specialist managers like Western Asset, like Martin Currie. Franklin Templeton has one of the world's broadest footprints in terms of coverage, looking at 34 offices around the globe, servicing clients across 160 countries. It's a world-class investment organisation, and I can say that personally, the transition in our partnership has been seamless. I'll now hand over to John, who will introduce Western Asset and discuss the macro environment.
Thanks, Cam. So just a little bit on Western Asset and our philosophy before we dive into the macro update, as Cam mentioned, and also touch a little bit on how we're positioned to take advantage of the environment as we see it. So Western Asset, as Cam highlighted, we're a globally integrated active fixed income manager. We've been specializing in the asset class now since 1971, so coming up to our 50-year anniversary. So really since the inception of fixed income as an asset class in the US, going back to the very early 70s. We're a globally integrated fixed income manager at scale, which is very important even when you're looking at Australian fixed income, because understanding what's happening around the world, whether it's from a central bank perspective, what the Fed's doing can have implications for what the RBA winds up doing, is very important, but also from a credit perspective, where a lot of the issuers in the credit market here in Australia and globally are global in nature. So thinking about large multinational companies that issue in different regions to fund their business operations around the world. So issuers here in Australia include the Bank of America, Apple, Vodafone, and so on. So having on the ground research in different parts of the world is very important for us to be able to implement our process here in Australia. So the Australian team, which looks after BNDS, is a very highly regarded team, very highly rated by the independent research houses such as Morningstar, Zenith, and Lonsec, and also a very award-winning team. They've won multiple awards over a number of years now. I think one of the most award-winning investment teams here in Australia. So I might move on quickly and just touch on our investment philosophy. We do believe it's important that our clients and investors understand this philosophy, because it will drive or determine our decision making over time, and ultimately the return series in which we seek to deliver to clients. So we're a long-term fundamental value investment shop, which is not dissimilar to much of what you have heard through different equity managers, be it Warren Buffett or Templeton or a number of other value managers in the equity markets. In fixed income, it does tend to be, I guess, a little less common, because a lot of the value orientated managers have probably not necessarily succeeded, where we've had certain investors or certain participants in the market, such as central banks, who are, I guess, they're not necessarily driven by price, they're driven by other factors. And so some out there with the value orientation have really struggled in the past 10 years or so. However, at Western, we've managed to do quite well in this environment, and that comes down to, I guess, one of the key drivers being our diversified strategy. So we believe in diversification. One, making sure we've got high levels of diversification across the securities and the issuers which we get exposure to, but just as importantly, making sure that our portfolio has different parts of it that are made up to perform in different market conditions. So if our base case doesn't come through, or it takes longer for that to come through, then we have a different part of the portfolio that will perform in that market environment and therefore smooth out the returns over time. So now moving on to the macro environment. Look, I think there's a fair reason or fair cause for optimism on the medical front when it comes to the virus. Now, while the numbers have definitely surged globally, not necessarily here in Australia, but globally, the doctors and scientists are doing much better in the medical battle relative to where we were in Q1 or Q2 this year. We've seen improved therapeutics, has seen the mortality rate decline significantly relative to the first wave, and now the efficacy of vaccines such as Pfizer or Moderna, or even today Oxford came out, are looking very positive, with the initial trials proving 90% or even higher from an effective rate. It's important to highlight that the more vaccines that prove effective against this virus, the better, because it'll help delivering the vaccine to more people more efficiently, but it'll also help when finding out which of these vaccines are more effective in different cohorts, such as the elderly. On the other side of the battle is the economic front. So we might go back one slide for a moment. is the economic front. So we've seen significant gains made here, and these have been underpinned by significant accommodation from central banks, regulators, and governments around the world. But that said, we caution investors, we're coming from a highly challenged position. The economic output gap is of a magnitude that we haven't seen in recent history. And there's also, I guess, some scarring that's going to remain in the economy and take some time to work its way through. Furthermore, we've seen a bifurcated recovery with some segments of the economy almost fully recovered, while others, such as the service sector, are still suffering a great deal of pain. So we think the caution should still remain in investors' portfolio, but ultimately there is some optimism for the future. So moving on to the next slide and looking at some economic indicators. So as I noted, the recovery's definitely started, and we've seen some of the leading indicators, such as what we have here, the Global Purchasing Managers Index, bounce back into positive territory. For those of you that are less familiar with this particular indicator, it's basically a survey of purchasing managers across manufacturing and service sector, and it just gives an indication on whether they believe that the market is expanding. So above 50 means expanding, at 50 means neutral, so it's staying the same. Below 50 is contracting. And so as we've seen, they dip down into quite negative territory through Q1 and Q2 this year, and have bounced back quite sharply. But if we look to the next slide and have a look at the actual economic data that's been realized, and what we have here on this page is the global output gap. So it's a comparison of what is the potential output from the global economy. So where is potential GDP relative to realized GDP? Now this chart shows you the last 50 odd years of the global output gap. And as you can see, the starting point, if you take today as a starting point rather than Q2 this year, the starting point is as significant a recession as we've seen anytime over the past 50 years. So even though we have seen a bit of a bounce back in the market, when you look at pricing of certain securities, it has fully recovered. This is not necessarily reflected in the economy more broadly. So moving on to the next slide. As a fixed income manager and a fundamental fixed income manager, if we were confined to selecting just one indicator or one driver of bond yields, so the level of yields in the market over the long term, we would select inflation as that #1 driver of yields. Now, while we're obviously not confined to this one factor, it is very important in our process to get a handle on where is inflation and where do we expect it to be over the coming months and years. So looking at the chart we have on our page, the left-hand side table shows you the market's pricing for inflation on average over 10 years. Now we've got that pricing as at the end of 19. We've got it as the peak of the drawdown in March 2020, and then we've also got it at the end of Q3 here September in 2020 as well. So as you can see for Australia, and bearing in mind December was a fairly optimistic time for the economy. We started with an expectation inflation would be on average about 1.4% over the next 10 years here in Australia. That got as low as 0.09%, so basically no inflation over the next 10 years, and it has bounced back to about 1.34, so almost fully recovered in the expectations of inflation over the next 10 years. And we think that this is probably a little bit too optimistic given the scarring and the headwinds that the market's facing. So as you can see on the right-hand side, the lines of realized inflation across some of the developed markets. The purple line reflects Australia, and as you can see, while we moderately pushed above 2% there for a brief period of time, core PCI has dropped into negative territory, and we think that it's going to be quite a challenge for inflation to break higher than their expectation, or at least from market pricing for some time. So moving on to the next slide, I might just do a bit of a recap on how we see things, and most directly how we see things impacting here in Australia. So as I highlighted, the global recovery is underway, but really the vaccine timing is key to how well and how quickly this recovery takes place. When we look to the market here in Australia and think about what the RBA has done, The RBA has originally implemented yield curve control, and they've also put in place term funding facilities to support the lending through the banks as well. And then after that, they put in place QE. So you might ask, what's the difference between yield curve control and quantitative easing? I think the reality is it comes into the definition of what they're doing. So quantitative easing, by its very name, is a quantitative measure of the easing that's going to occur over a certain period of time. So the RBA, for example, is going to buy a certain amount of bonds each month over a certain period of time, where yield curve control is not a confirmation that they'll buy a certain amount, it's confirmation that they will buy until yields reach a certain level, and they will continue buying to keep them at that level. So this is the first time that the RBA has enacted any policy, the likes of which we've seen, or has got to an interest rate as low as 0.1%, which we've seen. But the policy is very easy, and we think will support the economy going forward, along with the fiscal policy coming in from the government and the expectation that more will continue to come through with wage subsidies and infrastructure spending and the like. That said, we still think that the worst is yet to come when it comes from an unemployment perspective. I think that some of the policies put in place, such as JobKeeper, is hiding some of the real unemployment that is out there, and we will see unemployment peak somewhere around 8%. Looking forward, we do think that there is significant scarring in the market, and whether that's from a business perspective where the service sector will truly take some time to recover, or whether that's just the debt burdens that are out there and that have increased dramatically as a result of the virus. But this scarring will therefore, we think, keep inflation quite low, as well as probably underpin quite a moderate recovery as we move forward. Now, with all that said, we think that the fundamentals are okay. We think that the economy, especially here in Australia, is okay, not exactly exciting, but it is all right. And we think that spread sectors should perform quite well, or continue to be very well supported as investors continue their hunt for yield, based on the really low interest rates that are currently in the market and expected to stay in the market for the foreseeable future. So I might move now onto the portfolio itself. Now, just a quick overview of BNDS for those of you that might not be as familiar with it. So BNDS is basically the same strategy, or it's been matched to the same strategy that we've managed here in the market since 1998. So we've got an unlisted strategy, and we've brought that strategy out in partnership with the BetaShares team in an ETF to provide an additional avenue to invest in Australian fixed income assets. So it's been designed ultimately as I guess a bit of a one-stop Australian fixed income allocation. So allocating across credit, semi-government and government bonds, and managing around the benchmark, which is the Bloomberg AusBond Composite benchmark, to generate active returns or additional alpha above that. It's really imperative that this portfolio remains a core defensive holding. So the assets we purchase are all investment grade. It's a very high quality portfolio. And we can hold some sub-investment grade. However, through the history of the strategy, we really haven't done this because we're mindful that we want this to be a core defensive holding and really act as a ballast in times of stress, such as what we saw in Q1 and Q2. When we see the economy underperform relative to expectations and your equity portfolio struggle quite significantly. So moving on to how the fund is positioned. So the portfolio, as I mentioned, is active, and we will manage around the benchmark to allocate where we think the most efficient and effective allocations are for our clients. And right now, as you can see from the blue bars on the left-hand side, relative to the benchmark, which is the red bars on the right-hand side, we've got a significant overweight to corporate bonds relative to Commonwealth government bonds. So our overweight there is based on the view that we think that corporate fundamentals remain in check. They're not fantastic, but we're not predicting from that high quality corporate area a wave of defaults or anything like that. In fact, the Australian credit market is one of the highest quality credit markets, if not the highest in the world. So it is a very high quality market which we're overweighting. However, we're really mindful about that overweight. So while we are overweight from I guess a decent percentage there, it's important to highlight that these are quite short dated. So while we're lending to corporates instead of the government, we're lending to them for only a short period of time. And we're also biased towards really high quality credit, as in from a credit quality perspective, which I'll touch on shortly. From a duration perspective, we think that yields, as I've highlighted, will be quite subdued for some time. We think that it'll be fairly range bound, and so we've been tactically trading around the benchmark from a duration perspective, having been both slightly long and slightly short duration over the last couple of months. Having really entered Q2 quite long from a positioning perspective. Further to this, from a sector allocation, our overweight towards semi-government securities has been in the longer end of the curve. So while we're underweight from a percentage perspective, we've been overweight from a duration perspective into the semi-government, and really looking to benefit from the yield curve control that the RBA has put in place, which also purchases the semi-government bonds issued by states such as Victoria or New South Wales, WA, and so forth. So looking to the credit quality of the portfolio, as I highlighted, the bias within our credit securities is really towards higher quality credit names. So really focused in on that single A part of the market. So really high quality names that we like there, and to a lesser extent in the triple B. The triple B market tends to be focused here in Australia, at least, more on your multinational entities such as GE or AB InBev, as well as your infrastructure type names such as the Port of Melbourne, and so on, where they're able to run a triple B balance sheet to maximize their return to equity holders. However, the stability of their cash flows allow them to do that with a high level of confidence that we're going to get paid our money back, and our coupons on the journey. So while we've got that significant overweight to credit, as you can see from the bottom table, this has only really come to the detriment of a 1-notch downgrade on average relative to the benchmark. So from a AA plus rating to a AA, and keeping in mind that that's probably a higher credit quality than most governments around the world have. So in order to pick up some additional yield for clients, we're not doing it at the detriment of the quality and the defensive nature of the portfolio. So moving on to the next slide, and I do apologize for the amount of data on this slide, but I think it is one that's very helpful in understanding how we position the portfolio efficiently for clients. So if you look, draw your eyes to the middle of the table, you'll see the corporate IG line going across the middle of the page, and you can see, if you look to the middle of the page, the 0 to 1 reflects the maturity bucket. 0 to 1 year, 1 to 3 equals 1 to 3 years, 3 to 5, and so on. So as you can see, the corporate credit allocation that we have is heavily biased towards that 0 to 1, 1 to 3, and 3 to 5. Where we're happy to go out to 5 to 7 and beyond, it does tend to be in those infrastructure type names where we're highly confident in the credit quality of the issuer, and there's there may be structures in place such as the Port of Melbourne, which I mentioned earlier, where it has a 50-year contract and a 30-year non-compete on that asset. So you can't build another port in Victoria and compete on pricing with the Port of Melbourne over the next 30 years. So for a name such as that, we might be happy to go out to 7 years and hold some longer dated corporates. But for the most part, we have a short dated corporate portfolio. However, we're mindful that we want to retain that ballast in the portfolio. So that really comes through from our semi-government and government bonds. And as you can see on those two lines, they're really heavily positioned towards the back end of the yield curve. So holding longer dated government bonds to act as a ballast should we see a more negative outcome in the market, which is what we've seen. So really that defensive negative correlation with equity markets. So it's about layering risk is how we build our portfolios and how we think about that for clients and delivering higher income but still retaining defensive qualities. So moving on to the final slide from my section, and what we have here is the performance of BNDS, which has been running for a little over a year now, and as you can see, we've managed to outperform the benchmark over this time period. I think by a significant amount over the last 6 months, as some of our positioning has worked quite well in the recovery. What we show below that is the performance of the unlisted trust. As I highlighted, this strategy has been running now for quite a long period of time, since 1998, and the strategy has been able to deliver on these return objectives over a very long period of time. So active management can work in fixed income. There are a finite number of managers that can deliver it, but pleasingly, the Australian team at Western Asset has done so, and done so well. With such results, as you might expect, as I mentioned, the ratings are quite high, so highly recommended from both Lonsec and Zenith, with a silver rating from Morningstar and a 5-star rating from a performance perspective. So what I might do now is hand back over to Cam before we jump into some questions in a little bit.
Thanks, John. That was great. I always like hearing from you in terms of inflation forecasts and what your outlook is on the economy. I also found that global output gap chart really interesting, just showing the overall demand side issue that we face in terms of the global economy. I think that really summarises where we're at in terms of the COVID crisis at this stage. At BetaShares, we talk a lot about portfolio construction. I recently presented a webinar about asset allocation and how to select long-term core portfolio holdings. In my mind, there's 2 commonly used approaches to building out your client's fixed income core allocation. One is a tailored approach. So tailoring a client's fixed income exposure to suit that client's specific circumstances and their growth asset allocations. The second approach is to seek a single best-of-breed fixed income solution that can be used in a scalable manner across your business, across your client base. In my opinion, BNDS meets the needs for this second approach. It's that one-stop best-of-breed fixed income fund. We've talked previously about the inefficiencies of the broad market Ausbond composite index, which no longer gets you enough yield and doesn't hold the right mix of bonds to give you real equity diversification power. So hence, following a vanilla passive fund that tracks the Ausbond composite index exposes you to those inefficiencies. BNDS, on the other hand, gives investors efficient access to an actively managed, broadly diversified portfolio of Australian fixed income securities. Over the cycle, we've seen that BNDS has been highly defensive in periods of market stress, for example, Q1, Q2, as John mentioned, and it acts as a portfolio ballast. So it's well suited to be held in conjunction with risk assets like equities. As well as being defensive, BNDS is able to deliver net of fee outperformance by harvesting credit premia. John talked about that, leveraging the capabilities of Western Asset to identify mispricing opportunities across fixed income. And of course, being an ETF that trades on the ASX, you get accessibility, no minimum investment requirements, transparency of pricing, transparency of underlying portfolio, and intraday liquidity. So BNDS, the ETF, was launched a little over 2 years ago now. But if we want to look at a longer term track record, we can look at the unlisted version of this fund, the Legg Mason Western Asset Australian Bond Fund. So this fund uses the same investment strategy and has the same management fee. And that's shown in the chart there in orange. Over the longer term, this fund has beaten all the other well-known peers. And if this is a chart showing a 10-year history, but we can extend that out to 20 years and we see the same picture. It's also beaten the Ausbond composite benchmark. And so if we think about alternatives in the passive space, those funds that track the Ausbond composite obviously have a fee component. So in doing so, it's also beaten those passive Ausbond composite trackers. So I will say most pleasingly from a portfolio construction perspective, if you're going to use BNDS as your one-stop fixed income solution, while delivering outperformance, it's done this without losing the ability to act as a portfolio ballast at times of market stress. And perhaps we've seen that there's been some other fixed income managers who have been found out at various stages of the cycle. So a few details about BNDS. So the ETF, as was mentioned, was launched in November 2018, and it's certainly on track to delivering its investment objective of after fee outperformance over a rolling 3-year window. It's competitively priced as a fixed income, active fixed income exposure at 42 basis points, and of course that's really important for performance. And like all BetaShares funds, there's a lot of information about the fund and its portfolio characteristics on the BetaShares website. It's somewhat unique as an active fixed income fund in that the full portfolio holdings are available on our website. So full transparency, you can drill down and see all the individual bonds if you so wish. BNDS is highly recommended by Lonsec, recommended by Zenith, and silver, rated silver by Morningstar. So it's a very well regarded fund. In terms of what we look for core portfolio holdings, I mean, our starting expectation here for any core portfolio holding is that we're looking to hold over the long run, 5, 10, even a time frame of 20 years ideally. We need low turnover, and we want to make sure we've got exposures which are true to label and are going to be resilient throughout the market cycle. BNDS has certainly shown that it is defensive and it doesn't change its spots. We need to see compelling value. We know that there are issues with the broad market fixed income benchmarks. BNDS provides efficient access and offers the potential for net of fee outperformance. It has an excellent track record of doing so. And finally, and really importantly, all parts of your portfolio need to work together to improve risk-adjusted returns. When your defensive asset acts as a ballast, preserving capital and offering liquidity at times of crisis, this gives investors the ability to rebalance into risk assets when they've become cheap and have been beaten up. So you can participate in the rebound in those growth assets, those risk assets. So, BNDS really does provide that one-stop solution for clients' fixed income core allocations. It's just, in terms of portfolio positioning, it's an excellent, well-balanced blend, harnessing the credit premium available in those very high-quality, short-dated corporate bonds, and then using the duration or using the term premium from those very high-quality government bonds to provide a really well-rounded exposure to be used in client portfolios. Things to consider. Of course, all investments have risk. Please read the PDS for more information. And look, that concludes the presentation part of the webinar. So we've had a few questions come through. So I'll pose some of these to John. The first question is, does fixed income still provide any equity diversification benefit given where rates are at? And this is a common question. John, did you want to address that one?
Yeah, of course. It's a great question, and one that we at Western, as well as the market, grapples with. I think quite regularly. It's not the first time that we've seen rates quite low, albeit probably at the lowest level in history now. But I think if you think about an allocation of fixed income, what are you trying to source there? There's liquidity, there's income, and then there's the holy grail, which is the diversification, as you mentioned. So definitely the income level has dropped significantly, and expectations for income from a fixed income portfolio going forward has to be lower. Liquidity, while stressed during March, is definitely in place now, and the markets are deeply liquid. But then from a correlation perspective, in our opinion, we still think that fixed income provides that ballast relative to equities. Now we've seen, many markets, such as parts of Europe, really show that even in negative territory, fixed income can still provide that ballast. So what is negative can go further negative to provide you, from a yield perspective, to provide you that offset in price performance. However, in saying that, Australia, I guess, is one of the lucky markets where we do have a real yield curve. So we actually have, interest rates at a level, or yields at a level across the curve where we can see some performance from here. So as our 10-year government bond sort of bounces somewhere between 90 basis points and 1%, it can fall dramatically should we see things take a turn for the worse and provide that ballast against your equity portfolio.
Great, thanks, John. So we've got another question here, and we did touch on this, but it's worth reframing the answer. How should I expect BNDS to perform in a risk-on environment and a risk-off environment? Could you take us through that, John?
Yeah, that's a really good question as well, and that's really, I guess, what comes down to our diversified strategy. So that key tenet of our investment philosophy. So from a diversified strategies perspective, we have that overweight to corporate securities, which we think will perform well in an improving market condition. So while we're cautious about the future, we think if we continue where we're going, we're in a risk-on market environment, and we will see that continue to perform well. So getting the additional income that comes from that allocation, as well as potential capital gains. In a risk-off market environment, we have a bit of a curve flattener on at the moment, which just basically means that we're holding a greater allocation to the longer dated government bonds, which are highlighted through that very detailed chart with the table and all the data. So in our view, our ability to outperform during risk-on market conditions, and if you look through history, we tend to outperform quite strongly during risk-on market conditions, and then we tend to, I guess, perform in line with the benchmark or around benchmark returns during risk-off market conditions. Now, there's a very deliberate strategy behind that. History would suggest that around 80% of markets months are risk on, so outperforming in those risk on months is very important in order to make sure that you can outperform over the long term.
Yeah, absolutely. So there's a question here: how does your investment approach, your portfolio, differ from that of perhaps some other active managers in this space?
Yeah, I feel like I'm harping on about it a little bit, but it really comes down to the diversified strategies. We don't look to. I always revert back to cricket terminology. We're not looking to hit 4s or 6s from this portfolio. It's all about taking small wins in a risk-adjusted manner. So looking to get singles, your 1s and 2s in a cricket terminology. So really thinking about diversification and thinking about small wins as opposed to taking very large bets, which might get you a large active return, or it might go against you and you could lose significantly for investors.
Okay, great. So you're maybe the Michael Bevan as opposed to the Adam Gilchrist of bonds. Is that right?
That is a fantastic. That's a fantastic way to put it.
Okay, great. There's a question here about the RBA, as we know, recently announced that they're going to engage in quantitative easing, and that was a big step in this country. You did mention it, but maybe can you talk us through how you expect that to impact BNDS and maybe how you position for that?
Yeah, so I mean, coming into the announcement that the RBA made to, firstly, if we move back to yield curve control, coming into that particular announcement, we'd moved to a position where we were long the front end of the yield curve from a government perspective. So we went overweight where we thought that they would start to target, and given if you think about our economy from a lending perspective, it's much shorter term relative to the US. So on average, corporates in Australia borrow for about 3.5 years, and we don't have this longer term structure where corporates might borrow for 10 or 15 years more frequently. So the RBA, we thought, would come in and target the front end of the yield curve in order to get that down. So we overweighted that part of the yield curve in order to benefit from that. And then, as also highlighted, where we did go a little bit longer was in the semi-government bonds, where we thought that they would also purchase those to, I guess, reduce the amount of anomalies in the market. Coming into the second announcement, where they announced the quantitative easing policy, we really thought that they would target around that 10-year part of the yield curve. So we focused in on that 10-year part of the yield curve, moving to an overweight position there, which again benefited from that call. But again, we've been quite tactical in these moves because we think that there is, that it is going to be fairly range-bound market for a fair while until we can work through some of the broader structural issues in the economy.
Yeah. Okay. And I did say they're also targeting the QE, the semi or state government bonds, and you've obviously got well positioned for that too. So yeah. And there's another question here which I can probably address. Just a question as to the difference between BNDS, and we did mention it in the webinar, versus the unlisted fund, the Legg Mason Western Asset Australian Bond Fund. Is there any differences in strategy or fees and the like? The answer is no. So the exact same strategy, the same fees, If you actually look at the on-market bid-ask spread, that's the same as the unlisted fund. So it's simply a different way of accessing the same strategy, to answer that one. So look, I think that's all we have time for today. Thank you very much, John. Certainly appreciate hearing your insights. I'm sure the audience did too. Big thanks to everyone on the line who took the time to attend the webinar. It's highlighted at the start. You'll get sent a recorded version of the webinar along with the slides. For any information on BNDS or any of our funds, please go to the BetaShares website, as I said, and you can look under each fund page. You'll find all the relevant information, portfolio breakdowns, fact sheets. You can request research reports there. So thanks very much again, and enjoy the rest of your day.
Thanks, Cam. Thanks, everybody.